to the September Investor Advisory Review. I hope you've had a wonderful day and that things are going your way and that everything is working well for you right now. We're going through a lot of changes here, and so we've had a lot of ups and downs, but overall, I am very pleased with how everything's going here as well. So I'm looking forward to sharing with you what we have in this update for the September Advisory Review, and I'm glad you could join us. As always, just a quick reminder, this information is broad-ranging. There are things that I'm an expert on. There are things that I can cover as far as financial planning, investment, insurance, items that I'm fully licensed in. But there's other items that we talk about regularly on this program, items that deal with taxes and legal matters and so on. I am not able to give advice for those, but I can share opinions. But most importantly, you need to take that information and visit with your professionals as well to help make sure that you choose the right approach or avenue for your situation. So again, no matter what we're talking about here, whether it's tax issues, legal issues, investments, strategies, make sure that what you're doing makes the most sense for you as you work with myself or other advisors to help pull together the right needs, right goals for your situation. We'll take some time here at the end of the evening, as always, to answer questions. You can either type your question in the chat, or you could raise your hand, and I can see if I can bring you on live to ask your question out loud. So up to you, however you'd like to do that. Tonight, we're going to cover market and economic data again. We're going to talk about nitrogen and how we use that to estimate a portfolio's potential risk as well as its reward. We're going to take a look at the third trimester year-end tax planning strategies. Just a quick primer. I've talked about that the last couple of months, just trying to get everybody up to speed for it. But I want to just hit it one more time here as we're approaching that part of the year as we come to the end of this end of 2025. Take a look at the IXL financial dashboard that we offer to our planning clients so that you can think ahead about how you want to handle yours in this coming year. Also, got a few big announcements, actually a couple extra announcements this month that I'm looking forward to sharing with you. And then we'll take time then for your questions and remind you of the next advisory review coming up. So first off, we'll talk about the markets and where they are at this point in time. It's a little, it's exciting, but I will say it's a little difficult to get a beat on some of the things right now. So I'm going to go over that with you. Let me pull that up. So as we look at our data source, I'm going to share with you this screen here. This is the S&P 500, and it's going back for the last 1 year. And what you can see is that the market continues to go up, and it just keeps melting up. On one hand, I'm extremely glad about that. On the other hand, there's some things I'd like to see happen that might help make things a little bit better. But let me just share a little bit of that with you. First off, just a quick reminder, this line right here is the 20-day moving average. You'll notice that the daily activity has stayed above that, other than just a couple of places where it's bounced into it. Then we got the 50-day moving average. Then we have the 100-day moving average. And finally, we have the 200-day moving average. And you'll notice, I'm going to turn off the crosshairs. You'll notice that the parity, or the way it's set up right now, the daily activity is above the 20, the 50, the 100, and the 200, which is all very good signs. At the same time, while that should just make everybody feel incredibly confident, there is concerns about what's going on in the economy and the markets as a whole, because this continuous move up after what happened in April probably is a little disconcerting. And so we're going to talk briefly about some of that. Let's break some of this down a bit, take a look at the sectors. If we take a look at the various sectors here, for the last 90 days, what we find is that all of these sectors are below the S&P 500. And only these three here, which would be discretionary, communication services and technology, over the last 90 days are above, outperforming the S&P 500. What that implies is that we don't have as broad of a growth in the economy and the markets as we'd like. It'd be much nicer if all of these, or many of these, were doing better than the S&P 500, because that would mean we'd have a whole host of companies, as in particular stocks, that are doing better than the S&P 500. We see a wide breadth of improvement and growth, which would speak well for the economy. If we take a look at the chart this way, looking at performance, what you'll notice again is only three are outperforming the S&P 500. Everything else is below it in its performance over the last 200 days. And to be honest, that creates a part of the concern that I have. So let's take this a little bit further. If we look at these various sectors here, we'll take a look at the 3-month change. We can see that, as I just shared a moment ago, the 11 industries that make up the S&P 500, they're not doing quite as well as we would like for them to be doing. Again, we can see that communication services and discretionary spending are still doing pretty well. We could also say that financials are doing pretty well, but we'd really like to see more green on this chart. We'd like to see more green on this carpet, less red, and certainly not any of the bright red. That would help give confidence that the economy was actually really supporting what we're seeing in the market. Another way to look at this, to kind of put things in perspective, is looking at it based on the information we have for the various moving averages I was sharing with you before. If we go to the bottom here, you see that same chart I was just showing you, but now what I've done is I've broken out the 20-day moving average, the 50-day moving average, the 100-day moving average, and the 200-day moving average. And if we run on the belief that the 50 mark, right here, the line across each, is what we're looking for to support breadth in the markets and the economy, what we can see is that the 20 has already started to go below. And what that means is that at this point in time, for instance, 41% of the securities in the S&P 500 are actually producing what the S&P is doing. That means 60 are not. And that's problematic, but it's only for the 20-day indicator. We find that the 50-day is right about, the 20-day is right about the 50% mark. And so I'd like for that to be a little bit higher. Certainly the 100 and the 200-day moving averages are well above the 50 percentile. Now, why is this important? Because if we look at it, we can see that the lines are getting lower and lower. So again, for the market to do really well, especially looking at it from an economic viewpoint, what we're really looking for is to see the majority, 60, 65, maybe even 70% of the companies that make up the S&P 500, we'd like to see them doing well because that shows us we've got strength and stability in the markets itself. But without that, that means we just have a few companies that are keeping everything moving forward. And that can be more of a reaction, more of a FOMO, a fear of missing out, which can then turn into a fear of losing your shirt. So what we want to do is make sure that we have more strength. Now, why is this important? Because September, the month we're in now, October, next month, typically tend to be difficult months for the market. There are lots of options that come due. There's lots of switches and changes that happen in the market during October and September. And they typically tend to be the months where we have somewhat of a pullback in the markets. And so what I would say is this: for our clients that are fully invested right now, we're comfortable. I'm not seeing this as a bad omen. I think this is just something that we have to deal with. And so I think that as we look at the end of the year, I believe the economy and the markets themselves are going to do pretty well by the end of the year. Where this has been a little bit challenging for me is that we've had a lot of new clients and new money added into accounts. And so we've tried not to just throw everybody in because we couldn't quite tell after the tariff terror and some other things that have been happening in the economy. We couldn't quite tell whether or not it was going to keep going up or pull back. And so we've invested each month a bit more of those dollars, but we've had this last bit we've held out. And so at this point, to be honest, I'm hoping for a bit of a pullback, maybe 5 or 10%, so we could then help those clients with that last remaining cash capital to get that invested in the markets. The other reason I think this is a possibility, I don't think this is a long-term problem, but if you've been watching the news, there's been a lot of conversation about whether the Bureau of Labor Statistics has been fudging on information on the numbers they've been putting out. And it turns out they have. And so consequently, we're finding that the jobs growth we thought we had in 2024 wasn't nearly as good as we were hoping for. Additionally, we have seen a slowdown. We are seeing unemployment numbers begin to tick up a bit. And so those two pieces together are sort of adding an extra weight to the economy. I don't think it's long-term or problematic, but it is something that we're watching carefully, not only to take advantage of when to invest for our clients that still have some cash to work with, but more importantly, if anything were to happen that was more dramatic, to make sure that we could pull money out and keep everybody from minimizing losses as much as possible. So that's why I shared this with you, is to say that we're looking at this as one of the indicators that I use to determine how bad this is. Now, if I were to, I'm going to turn that that annotation back on again. Okay. And what I'll point out to you here is, so what we can see is this is when the market had the high back in February. And if you run this all the way up for these lines here, you can see that the market had been working its way up, but it had at that point started to work its way down again, which is very similar to what we're seeing here. And then of course we went into the whole market downturn that was down about 20% from February to April. And you can see we had all of that happening there. So again, it may not be a problem that it happens. We can see it come back pretty quickly, and that may be the case here. But we're watching it carefully for you, for your family, and for your income growth and risk tolerance needs. So this gives me some insight, and hopefully you as well, on how we're going to move forward here over the next couple of months. Outside of that, unless something happens with non-farm payrolls, I'm really looking forward to a really decent year this year. We've had a great year so far with clients' accounts, and I really think that we're probably going to see some more of that, even if we do have a bit of volatility here for the current market situation. As always, we talk about how different asset groups are working out here. So here's an example of 5 non-correlated or definitely different types of assets. So we're looking here at, this is Bitcoin or IBIT, which is an ETF that trades in crypto or Bitcoin in this case. We can see this performance has been over 100% for the last 12 months. We can see gold has done about 42% over the last 12 months. We can see that international has actually done about 32% over the last 12 months. We can see that the NASDAQ has done approximately, it's hard to read, 25.6%. Then we can also see here that the S&P 500 has done about 18. We can see high yield bonds have done about a little bit less than 9. And then long-term, more conservative treasuries have actually been negative at negative 6.9. So this kind of shows you some of the different asset groups and how when they don't correlate, they will give us some opportunity for growth that we might not see if we had everything in one group. It would also say to you, though, that sometimes these are going to be our best bets up at the top. And so what we do is we diversify to make sure we've got great opportunity for various positions. If I look at it from an asset allocation mix, if we take our most aggressive modeling, that for the last 12 months been about 15.9%, our more conservative growth modeling at 12.8%, moderate growth at 9.4%, and then conservative portfolio at 7.9%. Again, this would be that a person was invested all the way from 1 year ago till now. If you've been invested only part of that time in these portfolios, that's going to change those numbers for you. But you can see from an asset allocation modeling, things are working pretty well also. Now, how does this look as we go into 2026 and finish out this year and move into next year? Well, let's take a look at some of those items as well. Let me switch back over to where I was. So as always, we work with a diversified range of investments for clients, and they range anywhere from cash to bonds, stocks or equities, real estate, tangible assets, things like metals, energy, commodities, currency, the US dollar against the world, business interests, which are more private interests for investors that have $1 million of net worth or more, and then insurance and annuities for clients that want some of these various opportunities, but they also want to have protected portfolios, whether that's protection for income or protection against assets. So if the markets were to fall, they can feel comfortable that their assets can still be there for them. Those represent the 8 primary categories we work in, and then the subcategories. I won't say they're endless because they're not, but it seems like it. There's a lot there. As always, we try to use intelligent portfolio management to manage wisely during challenging economic times. Whether those times are good and we're happy, whether they're bad and things aren't working out as well, we try to protect. And then in the middle time where we're trying to figure out what to do next to take advantage of everything. That's why we say we're proactive where possible, reactive whenever necessary. And for those who've been with us for a while, you realize that is exactly what we try to do. So when we take a look at the U.S. economic forecast, the outlook for 2025 and 2026, what I would say is the overall headline is slow growth, cooling inflation, and a general rise in unemployment. Unless these tariffs that are out there keep inflation sticky or housing, labor weaken in tandem, in which case the Fed cuts could help to protect against it, but they would also tend to make growth go down a bit. Again, it's just how the wheels of the economic engine that is the U.S. economy function. Certain things help, and then those same things can also create problems for it. And so I would tell you that I'm expecting slow growth. I don't know if whether this unemployment issue is going to be a bigger problem, but it does look like it might tick up slightly, but not a lot. I think that the tariffs, my personal opinion is, even though this is the general consensus for economists that we follow, and I mean, a whole host of them, my personal opinion is the tariff inflationary expense has already been priced into what you and I are buying. What we see is that, for instance, cost of regular goods and so on have gone up a bit, but what's made it doable, workable, is that oil prices have stayed low. So buying gas at the pump has helped there, as well as, since oil is in almost everything you and I use, it has kept those costs a bit lower. If oil had been much higher, that would have been problematic. The other thing is that with interest rates a bit higher, housing costs haven't gone up quite as much. I know they have gone up, but they haven't done as much. And so rents and mortgage payments have stayed lower because, quite honestly, people are staying where they are instead of buying something new at this point. If interest rates drop in this month, which is what's projected to happen, and maybe a couple more times this year, that may change everything, and we might start to see some of that inflation come back a bit. But we'll have to watch and see. That's what we do here. And so each month, our investor advisory review will update you as to what we're seeing and help you kind of figure out how to make the best choices for yourself. If we try to break this out a bit, growth slow, not stalled, real GDP around 1.4 to 1.6, and maybe as high as 1.5 in 2026. Tighter financial conditions, tariffs, the uncertainty attached to that, cooler hiring. Those items may actually adjust some of this, what I just shared a moment ago. Inflation, bumpy, then easing. Headlines likely near 3.5% to 4% for late 2025, maybe going lower in 2026 as all of the tariff issues get pushed into the economy and get kind of priced into what's happening out there. Unemployment, maybe a gradual rise to 4.5% or 5%, but certainly not a surge. We think that with the new chief for the Bureau of Labor and Statistics, we think that's probably going to help to create some more stability and confidence in those numbers, which should help to also stem off what's going on here with unemployment issues. Finally, rates. The Fed is tilting towards an easing cycle, meaning that they're going to cut rates at some point here. We think something's going to happen in 2025, maybe even 3 rate cuts, maybe 25 basis points here in September, maybe again in October or November, and then maybe once again in December. It depends a lot on how the economy reacts to these rate cuts, and also depends on how the economy takes off. But all those pieces together make me think that we could be looking at some nice economic forecasts that would create better returns for the market between now and the end of the year. Why the drag? Policy and trade, higher effective tariffs and retaliation lift prices and trim growth for a while. Again, my personal opinion is that's already been priced into it, but we'll see here as things go forward. Housing affordability, mortgage costs remain restricted. Supply shortfalls keep mobility and productivity constrained, softening consumption, which, again, even if consumer prices are going up, but oil and housing are not going up, that helps to keep things a little bit lower, which brings us to tighter financial conditions and uncertainty, firms staying cautious on hiring and how consumers might be spending a little bit less because they're trying to figure out what's going on. So those pieces together, I don't know if you listen to this report and think, oh, that's great, or oh, that's bad. I think it's not a bad report. I'd like to see more growth. I'd like to see more opportunity with the markets and the economy in general. But I'm not upset about that report, and I think it should be a very stable and steady report between now and the end of the year, which gives me confidence as we're helping you manage your portfolio. I've shared this with you the last few months. This might be the last month you see it for a while, but I just wanted to remind you again that the thing about President Trump is he's a disruptor. He says things, he causes the markets to react, he causes the economy to react, he causes people to react. And during his first term, the S&P 500 went up 87%, which is almost doubling, but we had to endure that with 2 corrections and 2 bear markets. The first correction lasted 6 months. The second bear market lasted 6 months. The next bear market lasted 6 months. And then finally, the last correction lasted 6 weeks. So a lot of volatility. And quite honestly, it's a little exhausting for people that aren't used to this sort of thing. I just remind you that even though we're going to have this kind of volatility and fluctuation, his economic policies did create a pretty good outcome, almost doubling the S&P 500 in that 4 years and 6 months after he left office. That things did pretty well. So we're looking for a repeat of that. And so far, it looks like we're seeing that. We might have some volatility, but I do believe that with his policies coming online as they are, that this is probably going to help to create a good landing, hopefully a soft landing as we go forward. As we can see already, we're starting to see some of that happen with his policies and such. Now, when it comes to managing your portfolio, there's some additional things that we do, and I've been sharing information with you over the last 6 months on how we manage portfolios, how things are adjusting as we go forward. I wanted to share with you one last piece of how we manage, and I could go a lot deeper than this, but I'm going to at least lay it out here so you could see at least a model of how we do things. We build portfolios based on risk tolerance. For those of you who can remember your risk number from nitrogen, your risk number score is anywhere from 1, meaning you're a full-on risk avoider, to 99, you're a full-on risk taker. And your number is probably somewhere in the middle there. It may be in the bottom 50 percentile, it may be in the top 50 percentile, but somewhere in there, that's where your risk number is. And we try to put together a portfolio that matches that risk tolerance. So I thought I would pull up something and show you a little bit about how we do that. So the software we use, Nitrogen, it actually has a modeling that we do. This is our 50 scoring portfolio. We have a portfolio for a blueprint allocation that scores 50. Again, remember 1 to 99, so this is right in the middle of that. And some things that we can see on that portfolio is that its average annual return or midpoint expectation is 8.4%. It's not guaranteed by any means, but that's what this model should do based on the assets that we're holding in this model. It scores 51. We call it a 50 because it's within that range. That would mean that if we had a really, really good 6-month period of time, that portfolio could go up as much as 18.2% during a 6-month period. If we had a really bad one, it might drop as much as 9.8% during that same time frame, again, in a bad market. And I remind you, that's for a 6-month period of time. So if you take 2 6-month period of time, it could be somewhere greater than that or less than that, depending on how things work. The software itself identifies this represents a 95th percentile of likelihood. That does mean that a black swan event, something none of us are expecting, could offset that other 5% and make this better or worse than we're expecting. Now, the thing I wanted to really show you, though, is how this performance would work against, say, another portfolio. So we can see the average performance here, annual midpoint range, 8.4, not guaranteed, but what the portfolio should model out according to the 95th percentile. Annual dividends about 2.24%, and expense of the portfolio about 0.17, not including advisory fees, but the internals for the fund itself would be about 1.17 or 17 basis points, not even a quarter of a percent. Let's see here if it'll let me go back and take a look at the other portfolio. Sometimes these softwares today, in order to protect people from identity theft and so on, they time out fast. And this one's going to do that, I can tell. All right, so I actually got ahead of that. I had a plan for that. So let me show you what we did to give you a report for that. Here we go. So this is the report we just looked at, the BA50, Blueprint Allocation 50. And that's all the information you just saw a moment ago. But what I really wanted you to see was this, is how this portfolio would perform in a stress test environment. Stress test in this case being, here's 2013, the bull market. If we were to go through that same bull market in 2013 as we did back then, the S&P 500, which went up 32% during that time, this portfolio, being that's a 50, it's right in the middle, it did about 24% of that. It didn't match the S&P 500, but it did pretty darn good. 24% is not bad. Now, it's important to understand that if you can get a portfolio to match or come close to what the index you're using, in this case, the S&P 500 is, that's pretty good. So in reality, if we simply said, well, this is a 50 at 32, then if we had 16, that would be a good number. That'd be 50%. That'd be in the middle of that performance at a scoring of 51 on this portfolio. But this one, 24.3. So I feel pretty pleased about how this one balances out. Now that's at a good time. What happens if we have a bad time? What happens if we have like the 2008 bear market or Great Recession? What would happen there? Well, so the S&P 500 went down negative 36.8, almost 37%. This portfolio would also go down. It went down about 23.6%. Now that's a little more risk than I would like to take, to be honest with you. I would like that to have been more like that. What would that be? That'd be 18%. So it's a little bit more than what I would like, but that doesn't mean we wouldn't be making adjustments on it. But if we just put it in there, left it and walked away, it would have gone down less than what the S&P 500 did. If we take a look at the financial crisis itself, 53% is what the market went down. If we take a look at this portfolio, what it went down about 32% or about 18. No, that's not right. More like 21% less than what the S&P 500 did. And then finally, what if we had an interest rate increase, 134 bips, or basically 1.34%? What would it do? Well, the aggregate bond index went down 5.1%, but this portfolio went up 4.5. So now, again, these are just measurements trying to create an apples to apples comparison. What happens in real life can be totally different than that. And I'm not trying to imply that any of this is guaranteed. This is just the way we're able to build something to get a comparison to help clients understand how much risk they're taking and understand how much reward they can get so they can decide, do I feel good about that or not? This software, Nitrogen, is available. If you've not scored your Nitrogen number, you should let us know. We'd be more than happy to let you link in, because you can compare the portfolios you have with us with this software, but you can also compare your portfolios like your 401k or your outside investments if you have. You can compare those to say if you score 51, like in this case, but it turns out your portfolio is an 84, that would give you some insight. You should probably take a little less risk, rebalance the portfolio to match your current risk tolerance. Or maybe instead it's a 24, and you need to look at making some changes to make it so it matches what your risk tolerance is. Now, that was for this portfolio. This one here is our blueprint allocation for 80. So that's obviously a much more aggressive portfolio. I don't know if I go back and show it, but it does a little over 11% as its midpoint range, not guaranteed, but what we'd anticipate over a 10-year period of time, 95th percentile. Some years will be better than that, some will be worse. For instance, this portfolio during a very good time in the market at the 95th percentile, meaning that most of the time could do as well as 29.7, but it could also lose as much as 18.6 in a bad time. And so it kind of gives you some insight on how that risk tolerance would work. If you take that, say, for instance, on a $100,000 portfolio, that's an $18,000 decline. If you said to yourself, oh, I don't think I could sleep at night if that happened, that tells you that we've got too much risk here. And so we use this software to help people identify how much risk they can live with and the reward that they can get as they take that various risk model. Now, this portfolio has a distribution rate of dividends on top of everything else, 1.1%. Remember, the BA50 was higher than that, almost 2.5%. And its annual expense ratio, not including advisory fees, is 0.18. So it's a pretty inexpensive portfolio as well. These are some of the assets in it. But let's do the quick comparison again, same way, to a stress test. So again, S&P 500 did 32%. Matter of fact, I'll show you. We're doing apples to apples here, 32%. The 80, though, did 39% on the upside as compared to this one, which did 24%. So your additional reward for that risk model was you outperformed the S&P 500 and outperformed the 50 model as well. Now, you're going to see that the risk side, 36.8, which is exactly what the 50 shows on the S&P 500, this one went down 41.7%, a little more than what the S&P 500 did. And again, if that would concern you, then we should be looking at that model. We've got plenty of other models to look at, even more conservative ones. But if you say, you know what, I don't need this money for a long time, I'm okay to take some risk with it, this gives us an opportunity to help you do that and to create a model that matches where you are. If we go through the financial crisis, 53.1% was what the S&P went down. This will go down 56.7, more than what the market. Again, assuming that we just put it in there and walked away. That's not how we function. As I told you before, many times, we are proactive wherever possible and reactive whenever necessary, trying to protect against loss. And then finally, if the bonds went, interest rates went up 134 basis points, the bond portfolio would go down 5.1, but this one would go up +6. So it would actually outperform the bond index going from negative to positive. So this gives you some insight into how we can build a portfolio using the various mixing models that we have with those 8 circles, meaning cash and stocks and bonds, various types of tangible investments and some other programs as well, currency and such. Putting together a portfolio based on your risk tolerance is exactly what we do using the software. So maybe you don't score a 50 or an 80, maybe you score a 71. Well, we can build a portfolio so it matches your risk tolerance. That's one of the reasons we use this software. It's not perfect, but it's excellent. And it helps to bring together the outcomes that people are looking for, their risk tolerance, and the expectations they have to make that portfolio grow to meet their long-term needs. So again, we use this software to help clients understand how their risk and reward goals will look with their current portfolio modeled under using the same scoring evaluation. We also can use this to build portfolios to accomplish all kinds of opportunities. So if you want to talk more about that as well, be happy to share that with you and help you put together what you need. Now, talked about it the last few months. I'm not going to spend much time on it tonight, but we're at this point where we do our year-end tax planning for clients, where we take a look at what their taxes were last year, add in the new numbers for this year, and then figure out what the best options are to help them reduce their tax bill. Again, it's sort of the year-end thing that we do to help our planning clients make sure they keep as much money on their side of the balance sheet, not going to the IRS or state coffers for those who are in states that they have state income tax. So taking a look at the Tax Cuts and Jobs Act bill and how that impacts your taxes, as I've shared with you before, there's a number of things that you and I can do before December 31st. If we do not do any of these things before December 31st, on January 1st, it's over. We cannot do any of them. So that's why it's very important that we do tax planning. Take a look at where you are, what's happening, and take a look at ways to help reduce your tax bill this year. And again, all of the things in green right now, those have to be done before the end of the year if you're going to take advantage of those tax saving tools. Over here, on after December 31st, you can do these two things, the IRA and the SEP IRA, can be put in place before you pay your taxes. After January 1st, those are two options you have. If you have a plan to do something with an IRA or a SEP IRA, if you own a business, these are tools you could use for that. And we take a look at considerations for the future, because it's not just taxes this year. We also take a look at taxes in upcoming years. So you got qualified plans, distributions, things like pulling money from a Roth versus a traditional IRA, meaning that you get tax-free from a Roth. Those distributions are tax-free. And then the traditional IRA, those distributions are taxable fully. And so having that plan in place can help you reduce taxes in upcoming years as well. Charitable plan distributions. You might have some charitable intent that you like to do, and using certain types of lifetime income programs, certain types of specially designed trusts can give you lifetime income, give you tax breaks today, and give you tax advantages in the future, and give you income for life. And then those assets will then go to charity once you've passed away. Some people, that fits very well with their model. There's certain asset transfers you can do while you're alive that you wouldn't get tax breaks on if you did them in your will or trust. So these are tools we can use. Then finally, estate plan distributions, lifetime income for heirs, and asset transfers after death. Having good plans for how those fit together can also help to control your taxes on qualified plans, on certain types of other assets that you would be paying taxes on if you didn't do it beforehand. These are all tools that we can do as part of our year-end tax planning. So if you have not talked to us about that, please do. If you have done it in past years with us, just know that as we move into October, we're going to be calling you to sit down and review your situation. We'll be asking to make sure we have a copy of your 2024 tax return so we can put that in the software, and then asking for updates on your income and other assets, maybe deductions you have, to make sure that when we put the tax software together for your planning, we've got apples to apples comparison from last year to this year. Again, this is just taking a quick look at the tax rates for 2025. You can see this is for married filing jointly. Obviously, there's tax rates for individuals and for married filing separately, etc. But we just put this one on here. And then for those of you in states where you pay state income tax, that just simply adds to this. And so helping to plan for this wisely means that we can keep anywhere from 10 to even as much as 53% of your tax money on your side of the balance sheet. And so if you think about it for a moment, giving 53% between state and federal income taxes to the IRS and your state coffers, if you could lower that, that'd be a smart thing to do. That'd be wise. And those are dollars you could apply towards your lifestyle now or your lifestyle in the future. So hopefully you've thought this through and you have some questions or thoughts. Please feel free to reach out to us on that. As always, our process is designed to be client-driven, advisor-managed. We're here to serve you. What is important to you becomes our number one priority. But at the same time, we're trying to manage what's going on to help bring about the best outcome for you. So if you've got some key things that have to be dealt with immediately, we're here for you. But then we're also going to help move you forward, take advantage of how to invest wisely, how to meet your retirement planning goals, how to meet other goals you might have, like start a business or buy a house, how to make sure your estate planning and tax bills are all in place. All these pieces together are designed to help keep more money on your side of the balance sheet so that you can then use that to accomplish the goals that are important to you, whether that's your bucket list or taking care of family or charities that you care about. That's what we're trying to do, is help you have the most resources to do what you want to accomplish. This chart here, simply the idea that what we have is on one side of the mountain, we're accumulating. That's the pre-retirement phase. We climb that mountain, climb that mountain, climb that mountain. We get to the top, we plant the flag, we say, I'm retiring or I'm redirecting, and then we're ready to go. However, S of R risk right here, which stands for sequence of return risk. You may know some people that retired in previous years and the stock market went down, or they had problems with the investments they had and it lost a fair amount of money. It made it so they had to go back to work. With proper planning, you can minimize sequence of return risk and make it so that you can retire when you want to and stay retired as long as you want to. And so that's part of what we do when we're doing planning on the post-retirement or decumulation phase, to make sure you've got assets to last your entire life. When you get to the end of your life, you have end of life risk, which can deal with incompetency issues or incapacitation issues, where you're not able to handle everything, you get sick or hurt, you have cognitive issues. Those are things that we have to build a plan for to help make sure that clients have the best outcome there, especially if they've got a spouse or family members that are counting on them to make sure there's resources for them to live out the remainder of their life once you've passed. And so we want to help make sure end of life issues are well thought through as well. That's why we build it and then we pull it apart over time to make sure that it meets your needs, your goals, your desires, as well as not just for you, but your family as well. Because our goal is right here, your desired return on life. What is it that you're looking for in your life? What is it that you want to accomplish? What's your bucket list? And then what are the things you might be required to deal with? Things like taking care of family members, the next generation, or the previous generation. Maybe you got parents that you have to help, or maybe you have children you have to help. And so making sure you can do those pieces as well as make sure you enjoy your life as well. Those transitions can really mess up a financial plan as well. So try to help everybody stay on top of that so they can meet those needs and achieve their goals, their needs, their wants, their desires. Then finally, once you've passed away, those resources now transfer to the people that you put in your estate plan, your trust or will, and say, this is where I want this to go. And we want that to transfer as easily as possible and as inexpensively as possible, even expense-free if possible. So the plan is to make sure you've thought through each step of the way, phase 1, phase 2, phase 3, achieved your desired return on life, and can live your best life here to accomplish what you want to do for yourself, your spouse, your children, your extended family, and the ministries or charities you care about. That's what we do in these 3 phases. As I mentioned earlier, this time right here is when we start helping people to look through their tax issues, both current and future years. It's also where we help them look at their estate design, make sure that their beneficiaries are set up properly, just to make sure that everything is working well. This is part of our planning service. The first third of the year is focused on spring planning, review, and renew. Second part is focused on investment and insurance review and renew. And the last part is on the taxes, both current and future, as well as estate design. And so we're already starting to have conversations with people about how to do tax planning. So again, if you've not had that conversation, you want to, please feel free to join us or give us a call. We'll be happy to schedule that for you. All right, I shared a couple of big announcements. This one I did not share. And as I've been looking at what people are asking for and how things are coming together, I decided that it's time to take the investment advisory review, and any month where we don't have anything big happening, maybe spend some time dealing with some wealth education. I'm pretty sure you all know most of what I'm going to talk about, but just in case you don't, or more importantly, you've got people that don't know this, we want to make sure that they understand how to use some of the different tools that are available to manage wealth wisely. So for instance, using CDs in your portfolio, Maybe you've used CDs, maybe you don't even know what CDs are. We want to talk about what a certificate of deposit looks like, how it works in a portfolio, how you can use it, what are the pros to it, what are the cons to it, so you can decide if that makes sense for you. Also, looking at bonds in your portfolio, stocks, mutual funds, interval funds, exchange traded fund, different types of investment assets that can be used to help accomplish goals, whether those goals are for growth, for income, for flexibility to make adjustments down the road, for cash reserves so you can access it, for tax management, making sure that each piece you're using helps bring about the best outcome you're looking for. Also, looking at fixed annuities, indexed annuities, variable annuities, looking at these as a tool to use in your portfolio. Not that we're trying to sell you anything. What we're trying to do is give you the pros and the cons. What's good about them, what's not so good about them, what would work well, what would be a reason to stay away from those, and give you the education you need to make the right decisions on when you're putting your portfolio together. I would tell you that there are many things that I am not an expert on. There's a few things I feel like I am an expert on, but there are a lot of things that I'm not an expert on. But I have what I would call 1/3 expert knowledge, 2/3 expert knowledge, or 3/3 full expert knowledge. Like I said, there's just a few things that I would classify myself with full expert knowledge. But the things that are 1 to 2/3 expert knowledge, it's because I've learned enough to ask the right questions. And that's what this wealth education series is about, is giving you the tools to be able to ask the right questions, be able to feel confident as you make the decisions on how to manage family wealth wisely. We're also be talking about insurance, property and casualty insurance, long-term care insurance, term life insurance, universal life insurance, and whole life insurance. Each has pluses and each has minuses. There's reasons that each of these programs exist, and we're going to help you to identify why you might choose one or why you might not choose it. Again, just education to help you be a wise wealth management consumer. And so we're going to start that here probably next month, unless something big happens in the economy. We're going to start that next month and start taking a look at how these various pieces can help you become the best wealth manager for your family finances and help us to do a better job for you. As I told you before, we are now getting our videos out in a very timely basis, within 2 weeks at the longest, less than that in some cases. Our video editor, Rose, is doing a fantastic job. And as a matter of fact, I just sent 2 more to her. She's getting those up and they'll be on the website. We're also going to be creating other vignettes for those as well. And we'll be doing some things with YouTube and some other social media. So I'm looking forward to sharing that with you as we get those out and about for your benefit. You can share those with your friends or whatever. But the bottom line is it's going to be really designed to educate and help people understand how to make the most of what they're doing with their family wealth. So as always, we come to the end here where I'm ready to take some questions to answer whatever. You can, like I said before, type your question in the chat box, or you can raise your hand. Some of you I've been able to link on so we could actually talk about it. Others I have not. Maybe it's just my lack. I'm only 1/3 expert on this part. So we'll try. But if you have questions, this is that place where you do that. While we're doing that, let me remind you that our next investment advisory review is going to be October 21st. And so consequently, we're going to have a lot that we're going to cover there. If the market's kind of continuing along like it has been, and maybe there's a bit of a pullback, but nothing major, probably just do a quick update on the economy and the markets, and then spend some time on some of the educational wealth series that I want to create for you. So we'll be covering that as well. So if you have any particular questions, though, you'd like me to cover in upcoming investment advisory reviews, let me know. Tell me. We're here to serve you. That's what this is about. Client-driven, advisor managed. You say, this is what I'd like to know more about. We're happy to answer that for you. That's why, as the investor advisor review, it's about you. So, as I said before, we've covered a few things here. One, we talked about markets and the economic data, what we see coming. I feel mostly good. I see lots of blue sky. Yay, some sun. See a few clouds out there, but I think it's pretty good right now, to be honest with you. Hopefully you understand nitrogen a little bit better, maybe be able to use that to help you tie your rewards and your risk management thinking together. Talk about year-end tax planning. It's probably the last time I'm going to mention that on one of these meetings. So if you want to talk about it, please use this time to reach out and say, hey, I want to talk about tax strategies for 2025. Talked about the difference, how your IXL financial dashboard is designed to help you achieve your goals and to not just have the facts and the figures right, but also your feelings and desires as a big part of your family wealth management. share with you big announcements. Excited about that. And come back to your questions here. And I reminded you of the next advisory review. So let me back up here. Oh, there we go. All right. Let's see. Do we have any questions here? Okay. Questions right now. I always say it, and because it's really true, I believe it. That either means that you have figured it all out, you know it all, and everything's working well. Fantastic. Or it means I've confused you so much you don't know what to ask. So I'm going to go with the first one and think that you've got it all figured out, because that's what we're really hoping for. So now, having said that, it is about 6:20. I have kind of come to the end of what I have to talk about tonight. Hopefully, this has given you some food for thought and some things to work on and some ideas that can help you maximize your family's wealth management as well. So having said that, I think that, given a second here, see if there's any more questions that come up. Last piece I remind you of is this is available to everybody. We have some of these programs that we do that you have to be what's classified as an accredited advisor to attend, accredited investor, I'm sorry, to attend. Means you have to have $1 million of net worth, not including your house. Right now, these particular types of programs we're doing, they're for anybody that really says, I want to get better at managing wealth. And so again, if you've got somebody that you would like to invite, family, children, friends, whoever, just let Megan know and we'll send them an invitation. We'd be happy to invite them. If you want to just let them know, get the information, they can reach out to us and say, can I attend? And they'll be resounding yes. We'd love to have them join us. And if you have any questions, you can certainly call the office as well at 386-248-2121. And with that, I'm going to go ahead and let you enjoy the rest of your day. I think I'm done for now. If after the webinar is over, if you think to yourself, oh, I have a question, just email us. Megan at Frank's office, be happy. We'll get the information for you and be there for you. So having said that, I'm moving a little slow here, just giving you a chance if there's a question. I don't see a question yet, so I'm ready to bring this to a close. I'm going to tell you, I hope you have a wonderful week, a fantastic weekend, and God bless. And I just want you to know how much we appreciate having you as our client. And if there's anything we can do to help make your life the best it can be, please reach out. Let us know. We're here for you. So until next month, or unless I meet you at our next appointment, have a wonderful week and a wonderful weekend, and I'll look forward to talking to you soon. God bless.